You ever open up a company's financial report and just your eyes glaze over? It feels like you're trying to read a foreign language, right? Well, it's a common feeling. But hidden in all those numbers is a story about how that company is really doing, if you know where to look. So in the next few minutes, we're going to uncover that story together.
I mean, look at this. It's just a wall of numbers and jargon. It's dense, it's confusing, and honestly, it kind of looks like it was designed to be intimidating.
But here's the thing. You totally can. The secret isn't to read every single line. Who has time for that? It's about knowing exactly which lines to read. We're going to focus on just 3 key numbers that cut right through all the noise and tell you the real story. Let's start with the most important one.
Okay, first things first. Let's cut right to the chase and answer the biggest question there is. Did this company actually make any money? This is what everyone calls the bottom line. So where do we find that answer? It's on something called the profit and loss statement, or P&L for short. The easiest way to think about it is, it's just like a personal budget, but for a giant company. It adds up all the money that came in, subtracts all the money that went out, and what's left is either a profit or a loss. Simple as that. Okay, so to find this magic number, you're going to ignore almost everything else on the page for a second. Just let your eyes drift all the way down, right to the bottom. You're looking for a line that says something like total comprehensive income for the period. This is the real deal. It's the profit after everything's been accounted for.
And boom, there it is. For this 3-month period, the company made a profit of nearly 800 crore rupees. Now that sounds like a lot of money, but is it good? A number all by itself doesn't really tell us much, right? We need some context. We need something to compare it to.
And wow, here's that context. Just look at this. Compared to the same time last year, when the profit was only about 172 crores, it has absolutely skyrocketed. We're talking more than quadrupled. That's not just good growth, that's a huge leap forward and a really powerful signal.
Okay, so we know the company is incredibly profitable, but how? How do they pull that off? To figure that out, we've got to rewind a bit and go back to the beginning of the story, to the very first number on the statement, the revenue. This is the top line.
So let's jump back up to the top of that page. We're looking for total income. This is basically all the money the company brought in from its business before a single bill was paid. Let's see how that compares to last year.
And yeah, you can see a pretty healthy jump here. Total income grew from about 8,400 crores to over 9,700 crores. So business is good. More money is coming in the door. That's piece number 1 of our profitability puzzle. But it's only one piece.
But wait, here's something really important to remember. Just because your income goes up, that doesn't automatically mean you're more profitable. I mean, what if you had to spend a ton more money to make that extra income? That brings us to the other half of the story, the costs.
Right. Every business has to spend money to make money. You've got materials, salaries, you name it. And honestly, how a company manages those costs, that's often the real secret sauce to their success. So let's take a look at their expenses.
Okay, back to our document. Right under that income section, you'll see a whole list of expenses. Again, we don't need to get bogged down in the details just yet. We're looking for the final number in that section, total expenses. This is the sum of everything they spent.
So where is all this money actually going? Well, this chart makes it super clear. That giant blue slice, that's the cost of materials. It's taking up well over 2/3 of all their spending. This is a massive clue that we're probably looking at a manufacturing company. We're buying raw materials as their single biggest expense.
I mean, just to put this in perspective for you, they spent over 6,000 crores on materials. On their employees, about 620 crores. That's a more than 10-to-1 ratio. It tells you that the price of those raw materials is absolutely critical to this company's bottom line. If they can manage that cost well, they're golden.
All right, we've looked at the 3 key pieces of the puzzle: the money coming in, the money going out, and what's left over at the end. Now let's put it all together and see what story this statement is really telling us.
So here's the story in a nutshell. Act 1, their revenue grew, which is great. Act 2, their expenses also went up, but, and this is the crucial part, they went up way slower than the revenue. And the grand finale, Act 3, profit absolutely exploded. That is what brilliant cost management looks like.
So, in just a couple of minutes, what did we figure out? First, sales are growing nicely year over year. That's a solid foundation. Second, the company is being super smart about its spending, which is why their profit is growing way faster than their sales. And third, we know that their whole business really hinges on how well they can manage the cost of their raw materials. And that's pretty much it.
In just 5 minutes, you've read a financial statement. See? It's not so scary. This one page tells a really powerful story of a company that's growing and being incredibly efficient. But of course, it leaves us with one big question. Can they keep this up? Can they maintain this incredible profit growth? Well, that's the next chapter of the story, and we'll have to wait for the next report to find out.
Welcome back to the Deep Dive. Today we're putting aside all the noise, the headlines, the earnings reports, the rumors.
All of it.
We're stripping everything away to look at the rawest form of truth in the market, the price action itself. We're doing a forensic analysis of a single image.
It really is the closest thing we have to a market lie detector, isn't it? I mean, you can spin a press release, but you can't spin the fact that money changed hands at a very specific price.
Exactly. And the specimen on our table today is it's a snapshot of financial time. It's a daily candlestick chart for the stock, Ashok. That's Ashok Leyland on the National Stock Exchange.
And the time frame is key here. We're looking at a whole narrative arc, really.
Right. From about August of 2025 all the way up to the closing bell on February 9th, 2026.
And for anyone listening who maybe can't see the chart, don't worry, we'll paint the picture. Just imagine a mountain range. Over on the left, back in August, you're in the valleys, somewhere around 134 rupees.
Okay.
By the time you hike all the way to the right side, to February, you are standing on a very, very jagged peak, way up over 215 rupees.
That's a huge ascent. We're talking about a stock that's, nearly doubled, almost 100% move in just 6 months.
It's a monster run.
But our mission today isn't just to say, hey, look, it went up. That's the easy part. It's to look at the quality of that climb and maybe some warning signs flashing right at the very top.
Right. Because these charts, they're just maps of human psychology. It's all in there. Fear, greed, panic, euphoria. It's all encoded in these little red and green bars. And while the trend looks beautiful from a distance, like a postcard, when you really zoom in on that very last day, February 9th, the story gets a lot more complicated. It turns into a thriller.
Okay, let's not skip to the ending just yet. I want to understand the journey before we get to the destination, because context is everything.
It is.
A 5% jump after a 50% drop is a totally different story than a 5% jump to an all-time high. So let's go back, August 2025. What was the mood then?
Looking at the left side of this chart, the mood was hesitant. Indecisive, really. The stock was just chopping around in a consolidation zone.
Yeah, it looks messy. No clear direction at all.
You see the price just bouncing between roughly 130 and 140. It wasn't really going anywhere. If you were holding it then, you'd probably be bored out of your mind.
I would be.
And that boredom, that is exactly what the smart money loves. We call that phase accumulation. It's where the big players, the institutions, the funds, are quietly buying up shares without spiking the price.
They're building a position.
They're loading the truck before the engine starts. It's boring for the retail trader who just wants action, but that boring phase, that's where the foundation for the skyscraper gets built.
I see it. Okay, so they're loading up, and then as we move out of that boring zone, say into September, we start to see these smooth lines snaking through the candles. We've got a red one and a green one, moving averages, right?
Correct. Think of them as the average consensus of value over time. They smooth out all that daily noise.
In August and September, the price is just tangled up with them.
Exactly. It's like a swimmer caught in seaweed. It hasn't broken free yet. But watch what happens as we move into October.
The whole character of the chart just changes. It stops going sideways and starts angling up. And what really stands out to me is how the price treats that red line.
It starts to respect it.
It really does. I'm looking at the dips here in October and then again in November. Every single time the stock dips, it just kisses that red line and pounces right back up. It's like a trampoline.
And that is the textbook definition of a healthy uptrend.
Right.
That red moving average is acting as dynamic support. It tells you that every time the price gets a little bit cheap relative to the average, buyers just step right in.
They don't let it fall.
Not at all. Shows there's a strong underlying bid in the market.
Okay, so through the end of 2025, it's this steady, methodical grind upward. It breaks 166, it breaks 180. It's the kind of chart that, lets you sleep well at night.
It's beautiful, steady progress.
But then we hit that 2026 marker on the x-axis.
And the sleep well at night phase is officially over.
The slope changes dramatically. If 2025 was a steady 45-degree hike, January 2026 looks like a sheer rock climb. It goes almost vertical. What drives that sudden change in geometry?
Well, this is often what's called the Jan effect, or you could just call it a blow-off top phase. The psychology shifts from, accumulation to chasing.
FOMO.
Pure FOMO. Fear of missing out. People see it rising, they pile in. They're not buying on value anymore. They're buying because the price is going up.
It looks like it just blew right through that 197.53 level without even a pause. Just green candle after green candle. It looks powerful, but is that sustainable?
And that's the catch, isn't it? Visually, look at where the candles are now relative to those moving averages. Back in October, they were touching the lines.
And now there's this huge gap of white space between the price and its average.
The price has run away. It's left the safety net way behind.
Like a rubber band being stretched.
That's it exactly. In statistical terms, we call that extension. You can stretch a rubber band away from its resting state, but the further you stretch it, the more tension you build.
And eventually it has to snap back.
Physics demands it. The further you are from that moving average, the more violent the snapback tends to be.
Which brings us to the scene of the crime, the very last day on this chart, February 9th, 2026. This is where that rubber band seems to have reached its absolute limit.
The climax of the movie.
We have the raw data for this specific day right in the top left. I want to read these out because the difference between the high and low, it's wild. Open 210.50, high 215.42, a low of 202.56. And it closed at 206.04.
Okay, just stop there. Those are just numbers on a page, but let's be detectives for a second. Let's reconstruct the timeline of that single day. Let's feel what it was like to be a trader on February 9th.
All right, let's do it. Walk me through.
The market opens at 9:15 a.m. at 210.50. Now remember, the close the day before was lower, so this is a gap up.
So right out of the gate, the mood is just pure euphoria. Everyone is high-fiving. This stock is going to the moon.
Exactly. The buyers rush in immediately. They see that gap up and they panic buy. They push the price all the way up to 215.42. That's the high.
So at some point in the morning, looking at 215, the bulls are in total absolute control. The chart looks invincible.
Right. At that precise moment, at 215 rupees, greed is at its absolute peak. But then something happens. The narrative just flips.
What happens?
At 215, the selling pressure suddenly overwhelms the buyers. Maybe some big institutions decided, okay, that's enough for us, time to cash out.
Gravity kicks in.
Violent gravity.
Yep.
The price doesn't just drift down, it crashes intraday. It drops from that 215 peak all the way down to 202.56. That's a swing of what, nearly 6% in one day?
That's nasty.
Think about the psychological damage. If you bought at the top, you were immediately down 6%. You go from feeling like a genius to feeling like an absolute fool in just a few hours.
Wow. And it recovered a little bit to close at 206, but the damage was done.
The damage was done. The most important relationship is the open versus the close. It opened at 210. It closed at 206.
So even though it hit a new all-time high during the day, it actually finished the day as a red candle. It closed lower than where it started.
Exactly. And visually, this creates a very specific shape on the chart. You get a small red body at the bottom, and this very long line, we call it a wick, sticking out the top.
It looks like an inverted hammer or a lightning rod.
In technical analysis, we call that a shooting star. And it is one of the most reliable bearish reversal signals you can find. That long wick represents rejection.
Rejection.
It's the market screaming, we tried 215 and we hated it. The bulls tried to push the door open and the bears just slammed it shut in their faces.
Okay, so we have a scary-looking candle, a shooting star. But I have to play devil's advocate here. Can't a single candle just be a false alarm? I mean, sometimes the market just jitters, right?
You are absolutely right to be skeptical. One candle is just a hint. It's a whisper. To turn a hint into a conviction, you need to check the engine room. You need to look at volume.
Right, that's the bottom panel on our chart. Those vertical bars showing how many shares actually changed hands.
Think of volume as the truth serum for price. If price moves up on low volume, it's suspicious. It means there's no conviction. But if price moves on a high volume, it's real.
Yeah.
The crowd is involved.
Okay, looking at the history here, I do see a massive spike back on November 24th. It's the tallest green bar right in the middle of the chart.
And look what happened to the price that day.
It broke out.
It broke out. That was a breakout confirmed by heavy volume. That was institutions stepping in saying, we want this stock. That validated the trend for the next 3 months. That was good volume.
But now look at the bar for February 9th, the very last one on the right.
What color is it?
It's red. And it's tall. Not quite as tall as November, maybe, but it's significantly higher than the average for the last few weeks. It stands out like a sore thumb.
So on the day the price fell from its peak, a lot of trading happened.
Which means a lot of people were selling.
Precisely. This is what we call distribution. When you see a shooting star candle at an all-time high and it's accompanied by a spike in selling volume, it's usually a sign of a transfer of ownership. The smart money, the ones who bought back in August at 130, are handing their bags over to the dumb money, chasing the hype at 215.
That is a brutal way to put it.
But that's how the market works. For someone to sell at the top and lock in that massive profit, someone else has to be willing to buy at the top. The high volume tells us the battle was intense and the bears won the day.
So the price is extended, the candle shows rejection, and the volume confirms heavy selling. Is there anything else in the data that confirms this overheated theory?
Oh yeah, the evidence is stacking up. Let's look at the speedometer. That panel in the middle, sandwiched between price and volume, the RSI, or Relative Strength Index.
The jagged white line looks like an EKG monitor.
It basically measures the velocity of price movements. It goes between 0 and 100, and generally if it's below 30, a stock is oversold, too cheap. If it's above 70, it's overbought or too expensive.
And where are we right now?
Well, for most of this uptrend, the RSI has been healthy. It's been making higher highs right along with the price. That's good. But look where it is right now. It's scraping the ceiling. It is clearly in that upper zone, probably over 70, maybe even pushing 80.
But hold on, let me push back again. Some stocks, they can stay overbought for months during a big bull run. Just because the speedometer's in the red doesn't mean the car explodes, right?
That is a fantastic point, and it's one that trips up a lot of new traders. You're right. In a strong trend, a stock can stay overbought. Being overbought is not a sell signal by itself. It just confirms the momentum is incredibly strong.
So why does it matter here?
It matters because of the combination of signals. If the RSI was overbought, but the price was still closing green every day, I'd say ride the wave. But here we have an overbought RSI plus that massive rejection candle plus the spike in selling volume.
It's the convergence of evidence.
The engine is redlining, and we just hit a brick wall.
Ah, I get it. It's the context. Redlining on an open highway is one thing. Redlining while hitting a guardrail is a crash.
Perfect analogy. Trading isn't about predicting the future. It's about assessing probabilities. Back in August, at 134, the risk was low and the potential reward was high. Right now at 206, with all these indicators flashing red, the risk is incredibly high.
I want to touch on one last visual. The chart itself, it's got this Nuvama watermark, sleek dark mode. But look closely at the price candles again. There are these faint green lines wrapping around them, sort of like a channel.
Ah, yes. Those look like Bollinger Bands or an envelope channel. They basically represent the standard deviation of the price. They show you the mathematical normal range where the stock should trade.
And recently, during this January vertical climb, the price has been literally hugging the top rail. It's pushing against that upper green line every single day.
We call that walking the bands. It's a sign of extreme momentum. But again, statistically, a price can't live at the outer edges of the deviation forever.
It's stretching that rubber band again.
Exactly. Eventually, it has to revert to the mean. It has to come back to that center line.
And in that center line, the moving average is way down around, what, 180 or 190 right now?
Exactly. So if the price decides to revert back to normal, that's a potential drop of 10 to 15% just to get back to average. That's the downside risk you're looking at right now.
So let's just synthesize all this for the listener.
Sure.
We have Ashok Leyland, a stock that has been an absolute superstar performer for 6 months.
An absolute rock star. If you held this from the summer, you're sitting on a gold mine.
But we are standing at a crossroads. And the chart is telling us a story of, well, exhaustion.
It is. I mean, to summarize the evidence,
Yeah.
1, you have a parabolic blow-off move that just looks unsustainable.
Check.
2, you have a shooting star candle on Feb 9th, signaling a failed breakout at 215. 3, you have high volume on a down day indicating institutional selling.
Distribution.
And 4, you have an RSI that is completely maxed out. It feels like the music at the party has stopped.
The lights have come on, but some people are still trying to dance.
That's a perfect analogy. The easy money has been made. From 134 to 200 was the easy ride. From here on out, it's a dogfight.
So what does a trader actually do with this information? I know we don't give financial advice, but logically, if you're holding this stock, are you panicking?
You never panic. Panic is always expensive. But you do get defensive. If you bought near the bottom, maybe you take some chips off the table, lock in some of that profit.
Pay yourself?
You pay yourself. Or at the very least, you tighten your stop loss. You say, if this thing drops below 200, I'm out. You stop hoping and you start managing your risk.
And if you're on the sidelines looking to buy, you miss the whole rally and you're thinking, maybe now's my chance.
You sit on your hands. You do not buy a shooting star candle at all-time highs unless you enjoy losing money. You wait for the stock to come back to a value area. You wait for it to touch that red moving average again.
Patience pays.
In this game, patience is pretty much the only thing that pays. The market is just a device for transferring money from the impatient to the patient.
It's fascinating how a single image can contain so much narrative if you just know how to decode the language. It's not just lines, it's the collective decisions of thousands of people.
And the chart never lies. People on TV might lie, CEOs might spin the truth, but the price is the price. The fact that it closed at 206 when it could have closed at 215 tells you everything you need to know about the mood that day.
I want to leave our listener with one final thought to chew on. We talked about that wick, the rejection from the high.
The 215 mark.
Right. When a stock hits a psychological barrier like that and gets slapped down so hard it leaves a scar on the chart. That 215 level is now a ceiling. It's a resistance zone. My question for you is this. How much energy, how much good news or fresh money will it take to break through that ceiling again?
That is the multi-million rupee question, isn't it?
Okay.
Often after a scar like that, the stock needs to rest. It needs to consolidate to gather strength for weeks, maybe months, before it can even try again. It has to heal.
So don't hold your breath for 220 tomorrow.
I certainly wouldn't bet on it. I'd be watching for a retest of the support levels below.
A cliffhanger indeed. We'll have to see how the next few candles paint the rest of this picture. Thanks for guiding us through the data.
Always a pleasure to decode the lines with you.
And to our listeners, remember, the trend is your friend until it bends. Keep your eyes on the charts. We'll see you